Hi everyone. What we're going to be looking at is the basics for accounting for a subsidiary. Now, to set this up, we're going to have two companies, A, and just to keep the faith with the prior example, we're going to use company C. And company C has its shareholders D, who own, or at least up until A buys them out, they own 100% of C's equity. Now, A then comes along and takes a controlling interest. We don't know the exact percentage stake yet, so we're just going to call that Z. But they take enough to control C. So overall, A and C are now part of the same group. And they have paid X for that. Now what we have here is Z, and Z is the ownership stake, the ownership percentage, and for the example that we're going to work through here, we're going to say it is 100%. This isn't always the case, and you can certainly have control, and indeed many cases you can have control without 100% ownership, but for this particular case we're going to assume 100% ownership. X is the consideration, and this can take many forms. We're going to assume it's cash-based consideration and it's cash up front, but it could be deferred cash, it could be equity, it could be something else. So again, just keep an eye out on the type of consideration that's paid, but just for intents and purposes now, we're going to look at a cash consideration. Now, one last piece of the puzzle, and we haven't talked about that yet, is Y. And Y is, in effect, the value of C. How much is C worth at the time that A took control? So Y is the fair value of identifiable net assets. And so these are all the things which make up the value of C. These are all the identifiable net assets. These are all the things that you can see. It doesn't just have to be things on their books. So if you think C has cash, that's an asset and it's identifiable. But things may not be on C's books, which also get included. For example, brand name. We know accounting regulations usually prohibit brand names being brought onto the balance sheet, but if you can identify a brand name, then more than likely it will actually be included as an identifiable net asset. So for the purposes of this example, we're going to assume the carrying value of what is on C's books is equal to the fair value. So all the assets that C has are on the books, and the values for those things on the books are at their fair values. In the next few examples or next few videos, what we're going to look at is how we do the accounting for this particular situation.